Well, welcome everybody. Thanks for joining us. This webinar is being produced by Venable's Nonprofit Organizations Practice Group, and the topic is diving deeper into UBIT, how to engage sponsors in the hybrid virtual world. Before I introduce our panelists, just a few housekeeping items. There is a function on this program that allows you to submit questions through the Q&A function. If my experience from prior webinars is the same, we'll probably not be able to get to all the questions, but we'll certainly try to hit the ones that we feel are most sort of broadly applicable, and those that we can't get to, we'll try to get to after our presentation today. Also, just our group, the Nonprofit Organizations Group, hosts these on a monthly basis. We'll be having a webinar July 29th on intellectual property transactions and data privacy issues, which very excited about. Those are some very hot legal issues, and we've got two great lawyers here from Venable who will participate and give that presentation. That'll be on July 29th at 12:30. You'll get an invite for that, just like you got an invite for this one, but just wanted to give you a heads up on that one. So for today's program, first, I'm George Constantine. I'm co-chair of the Nonprofit Organizations Practice Group here at Venable. And we do a lot of work here in the Nonprofit Organizations Group, as you might imagine, on tax and particularly, the intersection between tax exemption issues and fundraising matters. So very often we are asked to and will advise on sponsorship agreements, the tax treatment of non-dues revenue, tax treatment of fundraising revenue, and what we can do or what you can do as a nonprofit organization to make sponsorship and make support of the organization attractive to companies and other supporters while managing your tax risk and lessening the risk that you might be having to pay unrelated business income tax. And I am sort of serving as moderator of today's discussion, and the two folks who are going to be pulling more of a laboring oar are Judith Kim and Ryan Kasdan. I'll start with Ryan. Ryan and Judith are both associates, senior associates in our Nonprofit Organizations Practice Group, been incredibly valuable on matters related to tax and tax exemption issues, but also are very capable on other matters that affect nonprofit organizations from time to time. Ryan comes to us from Columbia University Law School, and he was also undergrad at Columbia, and has, as I say, done a tremendous amount of work on these sorts of issues. And Judith, similar vintage, same year out of law school, came from Boston University School of Law, and is a graduate of Penn undergrad. So got a couple of Ivies on the panel, and me, who is not. Anyway, before we dive in, I'll talk a little bit here about our agenda. We are hoping to get into really good discussion on the new world when it comes to fundraising activities for nonprofit organizations. Last year went abruptly from in-person fundraising activities, in-person conferences, in-person trade shows to totally virtual. We all know that there was, no gathering anywhere. What we're seeing more and more of now is and I'm sure you are seeing it as well, but with our clients that we work with, and we work with a number of nonprofit organizations, is a move towards a shift towards virtual plus in-person, so some type of hybrid event. But before we get to some of the specifics of what those unique issues that may arise by virtue of moving to a hybrid type of fundraising activity, we'll give a brief overview on the unrelated business income tax and why this matters and what risks are generally for organizations that engage in activities that might be viewed as promotional or advertising sponsors or supporters. And then after the general discussion, we'll take that deeper dive and focus more on very specifically sponsorship and convention and trade show issues. And as I said, hopefully we will have some good time for questions and get into the weeds a little bit to the extent that you want to, and those questions direct us in that way. So as I said, we're definitely seeing a much more move towards hybrid events. I think a lot of our client sponsors were sort of team players last year when there were issues regarding not being able to deliver on sponsorship benefits that were promised. If you can't have a banner at a meeting if you're not having a meeting. And many of our organizations, clients scrambled to give sponsorship benefits that might somehow approximate what was missing and what they weren't able to do. But now moving forward, I think we've got a different environment where sponsors are looking a little bit more for that return on investment, understanding that they may not be able to have as big an in-person meeting event activity, but knowing that may be an aspect of what's being done. And so a lot of our organizations are looking for innovative ways to offer those benefits that keep the sponsors happy, keep them coming, keep the money flowing, but from our perspective, keep the risk relatively low on the tax side. What we're seeing with the events coming back is obviously organizations that rely on strictly regional or local events that didn't involve any international travel are probably taking a more quick move back into in-person. But a lot of the groups we work with have a lot of international attendees or expect international attendees, and so just by virtue of the state of the world with the pandemic, that hybrid approach seems to be very much something for 21 and probably into 22 for at least before things go back to more in-person specific. The thing that you're going to hear though is while there's sort of fast moving developments in terms of how events are happening, obviously the advent and sort of growth of the internet and the different types of technologies that can be used to complement an in-person event to create a good user experience for those who cannot travel has moved quickly. Those developments have happened quickly. Unfortunately, on the legal front, the IRS and Congress have not moved quickly to reflect the fact that there are these new avenues for delivering content, delivering recognition to sponsors and that sort of thing. So, to the point where the most recent sort of precedential guidance that we have to go on is 2004, and that, as you'll see, is very much been rendered outdated by advent of technology. So what we're trying to do and what you'll hear today is a lot of interpretation based on rules that have been in existence well before this technology has been around, and we're going to make some some judgment calls, and you're going to have to too when you make decisions about what type of risk you want to take and how how risky you want to go with the sponsorship benefits you offer and the tax treatment that you give to those. But I just sort of say it at a very high level at the outset, understand that we have not been blessed with much guidance from the Internal Revenue Service or from Congress on how to handle these unique issues. And it doesn't help either that we've also not only have we not received precedential guidance, there's not been much enforcement from the IRS and not many sort of private letter rulings or technical advice memoranda or things like that normally you can use to help fill in the gaps when the precedential guidance isn't there. So I think that's enough for me, sort of setting the stage, not wanting to take up too much of our panelists' time. I'm going to turn it over to Judith, who's going to get started talking about UBIT generally, and Judith and Ryan, just let me know when it's time to advance.
Sure. Thanks, George. Hi, everyone. As George mentioned, my name is Judith, and I'm a senior associate in the nonprofit practice group. And we'll start off by just giving an overview of what exactly is unrelated business income, what happens if your activity qualifies under the definition. Next slide, George. So as a general rule, as I'm sure you're aware, tax-exempt organizations, the benefit of them is that they don't have to pay federal income tax on their income. However, if an activity qualifies under the definition of unrelated business income, then the organization will need to pay federal income tax on that revenue. But of course, it's really not that simple. Even if your activity satisfies the definition, the activity may still qualify for an exception to UBIT, and therefore the revenue from that activity still may be exempt from federal income tax. So next slide. Before we go any further about all the different ways that you can have your revenue be exempt from tax, we want to discuss what really happens if you have unrelated business income. Even though, as George mentioned, this presentation is really focused on ways to be exempt from paying UBIT, there really might be some solid business reasons why you want to go forward with that activity, even if you have to pay tax on that revenue. So what happens? Well, first, the primary consequence is you have to pay tax on the net unrelated income, business income at the corporate rate, which at this point is at 21%. And you also have to file a separate Form 990T with the IRS if you have more than $1,000 in total gross unrelated business income in a given year. For 501c3 organizations, there's a couple of additional things that you need to consider. First off, you really do need to be careful about the amount of unrelated business income that you generate in a given year. If you have more than what's called an insubstantial amount, that may impact your tax-exempt status. And unfortunately, there's not really a specific formula that you can rely on what's considered to be insubstantial. And the IRS does take a look at sort of all the facts and circumstances in making this decision. But we do use as a general rule, based on the IRS guidance that's out there in court decisions, that as a general rule of thumb, you're probably fine as long as your unrelated business income is 20% or less of your activities or revenue. And so if you think that your 501c3 organization is sort of exceeding or getting close to that amount, that's probably when you might want to consider some alternate options, like creating a for-profit subsidiary to engage in that activity itself. So for other exempt organizations like 501c4s or 501c6s, social welfare organizations or trade associations, then you probably have a little bit more leeway on the amount of unrelated business income that you can generate before it really becomes an issue for your tax-exempt status. One other item that 501c3 public charities should really keep in mind is how your unrelated business income impacts your public support test if you rely on one of the two tests to qualify as a public charity. Unrelated business income is included in organization's total support, but it's not counted towards the part of your public support, the numerator in the equation. And so the more unrelated business income that you have, the lower that your public support percentage may become. And so this might really not be an issue if your public support percentage is way higher than the 1/3 that's generally required to qualify as a public charity. But you may want to keep a close look at this amount of unrelated business income that you generate if your organization is closer to the 1/3 public support that's required to satisfy the test. And so if you're looking at the public support test and you're concerned about the amount of unrelated business income and the impact on your public support test, then you might want to consider alternate options in how to engage in that activity, even if it doesn't even rise the level of the insubstantial, more than the insubstantial amount that I discussed previously. So once you consider these factors, though, you may still decide that it's still worth to move forward with an activity, particularly since you're still able to keep a good chunk of your money even after you pay tax on the income's activity. So I caution you that before becoming too wary of generating unrelated business income and trying to fit in an arrangement into one of these exceptions that we're discussing, if it really doesn't fit really in one of these exceptions, and so therefore paying tax might not be the biggest issue.
Thanks. Just to chime in there, that's oftentimes with sponsorship, we'll start to get the discussion about what's a permissible benefit and what's not to benefit from that exception. But you may reach a point where it's like, well, this is a big sponsor, and this is a benefit that we're willing to offer and pay some tax on the value of it, and not have the sponsor walk away. So, right, that's always a good reminder as we go through this discussion. There are many organizations that will have at least tolerance for some UBIT. And the good news about UBIT and the tax rate is, it has gone down not too, relatively recently to 21%, where it had been at 35%.
Yeah. So next slide.
Okay.
So going back to the original question that I posed in the beginning, what is unrelated business taxable income? So an activity qualifies under this test if it satisfies essentially these three factors that are laid out here. It has to be a trade or business, it has to be regularly carried on, and it has to not be substantially related to your exempt purposes. So if you look at the next slide, focus first on sort of the trade or business factor. Now, trade or business is defined fairly broadly as pretty much any activity that is carried on to produce income. So making a profit from an activity in a given year is not really needed for that activity to qualify as a trade or business. So one of the things we look at in deciding whether or not this factor is satisfied is to see if a for-profit company engages in a similar activity. And I do have to say this factor is pretty easy to satisfy since the definition is so broad. The second factor, whether an activity will be viewed as being regularly carried on, how you determine this is really you look at what for-profit companies do in the sort of the similar activity. And if a for-profit company engages in an activity as often as a tax organization does, then that will sort of satisfy that factor. So on the converse, though, for example, if an activity that is carried on by a tax-exempt organization is engaged in only 1 to 2 weeks in a year, and in contrast, a for-profit company engages in the activity pretty much year-round, then you have a pretty good argument that that activity is not being engaged in on a regular and carried on basis. So an example of this, if you move to the next slide, is ads that are sold by the NCAA during the Final Four tournament. So selling ads to for-profit companies is typically not really related to an organization's exempt purposes and definitely qualifies as a trade or business. As you can see on the example on the left, the Coke ad is pretty typical of what you would see on TV or nowadays on places like Hulu or YouTube. And however, the NCAA argued that the ads that they sold during the Final Four tournament should not be taxable because they were only published over 3 weekends during the Final Four tournament and therefore was not considered to be regularly carried on. The IRS disagreed with this position, and so they took it to court, and the court ultimately actually decided with the NCAA, although the IRS doesn't actually officially agree with this position. The court ruled essentially that the NCAA's advertising, because it was only published over 4 weekends or 3 weekends, that it's not regularly carried on in comparison with sort of traditional advertisers that engage in the publication sort of year round. And so they sort of won on that. And so in that situation, NCAA doesn't have to pay tax on the advertisement that they sell through the Final Four tournament. So in contrast to this, the IRS is generally not really taking an issue with sort of traditional fundraising events that you see, like golf tournaments that are held once a year to raise funds for a tax-exempt organization, which we think is due to in part because of the IRS's view that those fundraising events are really not being regularly carried on by a tax-exempt organization. So if you go to the next slide, the third factor is whether or not an activity is substantially related to an organization's exempt purposes. So when you're looking at this factor, you really have to look at the activity itself rather than looking at whether the revenue will be actually used for an organization's exempt purposes. And needing income, unfortunately, is not enough to satisfy this factor. So as you can imagine, this factor really requires looking at all the facts and circumstances, including how an organization actually qualifies for tax exemption under the Internal Revenue Code. So one example of how fact-intensive this test can be is, go to the next slide, is let's just imagine that the Louvre is a US tax-exempt organization, just for the sake of argument. And it's selling the 2 items that you see on the screen. It's selling a bag that displays the Mona Lisa, and it's also selling keychains of the Eiffel Tower. So selling the bag on the left might be viewed as advancing the Louvre's tax-exempt purposes, since it's making art that's displayed at the Louvre become more familiar to a broader segment of the public by encouraging people to purchase it and sort of carry the bags around in public. And so that helps the public understand and appreciate art more, and therefore, which is consistent with the Louvre's tax-exempt purposes if it were an organization exempt in the US. In contrast, selling the keychain with the Eiffel Tower is probably a little bit more questionable, since it's not accomplishing the goal of encouraging the public's understanding and appreciation of art. And so the revenue associated with selling the keychain may not be viewed as being substantially related to the tax-exempt purposes of the Louvre. So all to say that this is probably the hardest factor in really looking at this test, because it really depends on all the facts and circumstances, including what the organization has been doing and what it plans on doing through that activity. So if you go to the next slide, as I mentioned earlier, even if an activity satisfies the 3-part test, the revenue from that activity may still be exempt from tax. And so we've listed on this slide the more common exceptions and modifications from UBIT. And these provisions are identified in the Internal Revenue Code as exceptions, modifications, exclusions, but regardless of the label, if you satisfy the definition for any of these categories or the other categories that are provided in the Internal Revenue Code, the revenue from your activity will still be exempt from federal income tax, even if it does satisfy the 3-part test that I just covered. And so as George mentioned, due to the pandemic, we've seen a lot of more clients move their events online or in a hybrid model. And so we thought we'd focus on sort of the 2 exceptions that are highlighted in green in this slide to which are, the corporate sponsorships and the convention trade shows. And so first, Ryan will cover the qualified sponsorship exception to UBIT.
Thanks, Judith. So let's dig into sponsorships. As Judith mentioned, qualified sponsorship payments are one of the common exceptions to UBIT and one of the major focuses of today's presentation. As we will discuss, the qualified sponsorship rules provide a helpful safe harbor from UBIT, but failing to qualify for the safe harbor does not mean that the entire payment is necessarily taxable. So what is this qualified sponsorship payment? And let's go on to the next slide. At its core, it's pretty simple, right? So it's a payment of money, property, or services to an organization without a substantial return benefit to the sponsor. Although some benefits can be provided in return, the key here is really to determine if the benefits provided will be a substantial return benefit or if the benefits can be disregarded. If they constitute a substantial return benefit, then only the payment amount that exceeds the value of the benefits will be a qualified sponsorship payment. Next slide, please. A substantial return benefit exists when the fair market value of all return benefits, other than acknowledgements of the sponsorship, exceeds 2% of the sponsorship payment in the taxable year. So again, we look at all the return benefits together. This could be advertising, licenses, services, other benefits, which could be related to your exempt purposes or not. All of them are taken together. And if the fair market value is less than 2% of the sponsorship payment, then you're covered by the safe harbor. If the fair market value exceeds 2% in the taxable year, then the entire value of the benefits in that year, and not just the excess, is considered a substantial return benefit. As a practice tip, I want to encourage you to use written agreements that clearly specify the benefits being provided and the fair market value of those benefits. This allows you to rely on the fair market value of the benefits at the time the agreement is executed, rather than having to determine the value when the benefits are provided, which is the typical rule. This can be especially helpful in multi-year agreements when the value of certain benefits may increase over time, or where return benefits are potentially close to that 2% threshold. So,
Ryan, I want to emphasize that. I think that's so important if we can do it. Understanding sort of we're dealing in the world of, some expectations on the sponsor side, where a breakdown of the value of each benefit may be, they may not understand that, or it may be confusing to them. If you can explain to your sponsors that this is, for our internal purposes, and it helps us very much on our tax risk side, the breakdown of the value of the benefits can be very helpful in managing your risk on this front. Sorry to interrupt.
No, thank you. So let's go to the next slide, and we're going to go through just a few simple illustrations. So in this first example, we have a sponsorship payment of $100,000, and the return benefits are free tickets to an event and advertising, both of which have a fair market value of $500. Our 2% substantial return benefit threshold is $2,000. And so because the combined fair market value of the two benefits is $1,000, we don't exceed the threshold, and the entire sponsorship payment of $100,000 would be a qualified sponsorship payment. Now, if we go to the next slide, we have similar facts. We have another $100,000 sponsorship. Again, the 2% threshold is $2,000. But here we have free event tickets with a fair market value of $1,500 and advertising with a fair market value of $1,500. When you add that together, we have a total fair market value of $3,000, which exceeds our safe harbor threshold. Because of that, we have the entire $3,000 of benefits being a substantial return benefit, and we have a $97,000 qualified sponsorship payment. Now, if we go to one last example on the next slide, we'll see how it works with a slightly more complicated situation. So here we have another $100,000 sponsorship in total, but it's a 2-year contract, and we have $60,000 in sponsorship payments in year 1 and $40,000 in sponsorship payments in year 2. Our 2% threshold for year 1 is $600, and our 2% threshold in year 2 is $400. The year 1 benefits have a fair market value of $500, and the year 2 benefits have a fair market value of $500 as well. As you can see in year one, even though we're giving the same benefits as year two, in year one, we do not have a substantial return benefit because it doesn't exceed the 2% threshold. The same benefits, though, provided in year two do exceed the threshold for year two. And so in that year, you would have to deduct the $500 from the sponsorship payment, and what you are left with is the qualified sponsorship payment in year two.
And just to emphasize something here too, and Ryan's been very careful about his wording for good reason. Just because the substantial return benefit is a substantial return benefit, it doesn't necessarily mean that that value is taxable to the organization. It pulls the benefit out of the sponsorship realm, and you don't have the benefit of that exception. I like to call it a safe harbor for sponsorship, but there may be another exception, or it may be a related benefit to the organization. So there are other reasons that you still may not be in UBIT land with the benefit, even though it's a substantial return benefit under the sponsorship analysis.
Yeah, and that's exactly right. And we'll later on, you'll see, we'll get to some more detailed discussion about that, but that's exactly right. Just because the qualified sponsorship payment or the qualified sponsorship rule doesn't apply to the full payment does not necessarily mean that you're in UBIT trouble land. So if we go to the next slide, so now let's talk about sponsor acknowledgements. Sponsor acknowledgements, as you probably know, are a great way to publicly recognize your sponsor without jeopardizing the safe harbor that we've been discussing and triggering the substantial return benefit calculation. Key to an acknowledgement is that it's not an advertisement. So it should not include statements about the value, price, or benefits of the sponsor's products or services. It also should not include an endorsement or otherwise be used to encourage people to buy your sponsor's products or services. That all being said, there's a lot that acknowledgements can include. So an acknowledgement can include logos and slogans of the sponsor, contact information, displays or depictions of products and services, and other value neutral identifying information about the sponsor. Two things to note on this: if you include a sponsor's slogan, it shouldn't contain any advertising type language, no qualitative or comparative descriptions, but there is a carve out for slogans that are an established part of the sponsor's identity. Second, when providing a sponsor's contact information, you can include an address, phone number, link to the website, but you need to be careful not to link to specific product or sales pages. This could be interpreted as encouraging people to go there to make purchases, and that would not be acceptable under the qualified sponsorship rules, making it an advertisement. So best practice is to link to a homepage if you are going to link to a sponsor's website. Now, if we go to the next slide, we have just a few logos and slogans here. We have a pretty standard Nike logo with "Just Do It," their slogan. You could put that pretty much on any acknowledgement of a sponsor, of sponsorship, and it wouldn't be an issue from an advertising perspective as far as the logo is concerned. Next, if we look at Meow Mix, the only one cats ask for by name, putting aside whether cats actually ask for it by name, we see that the slogan has a comparative quality to it, but if we determine that that's part of the brand's identity, it might still be okay. And then finally, we have this beautiful Venable logo with our phone number below it. If you were to ever put that on a acknowledgement of some sort, acknowledging Venable sponsorship of something, it would be fine to have the phone number. You could have our address, website, and that would be fine. That would be considered an acknowledgement. Now, if we go ahead to the next slide, we have two examples of what maybe look like acknowledgements, but are advertisements. So in the first box here, we have a message thanking our sponsor, Musicland, telling people to go there for all their music needs. The first sentence is a pretty simple acknowledgement, thanking the sponsor for their sponsorship. But the second statement encourages people to go to their store and purchase, get their music needs there. So the advertisement and encouragement to purchase products in the second sentence would make the entire statement an advertisement. In our second little box, we have Made Up Music Association of America, Hearts Taco Land. And here, even though they're not directly encouraging people to go buy their products, to go buy their tacos or go to Taco Land, there's still an implied endorsement here by hearting them, and this would not be considered an appropriate acknowledgement in the sponsorship context. So if you go to the next slide, another way that you can acknowledge a sponsor, and this is where we start getting into some of the more creative aspects of sponsorships, is by calling them an exclusive sponsor, an official sponsor, or designating them in some kind of way that signifies their importance to your group or to your event. A sponsor can be an exclusive sponsor for a particular event or any particular category, and it's fine to identify them that way publicly. What you need to be careful of is not giving away exclusive provider arrangements in exchange for a sponsorship payment. So where someone can be an exclusive sponsor, if they're an exclusive provider and they're the only company that's allowed to provide soft drinks at your event as a condition of them sponsoring your event, that would be a substantial return benefit to the sponsor and would not fall within the acknowledgement category.
I'll say that this exclusive provider, exclusive sponsor, back when these regulations that the IRS was preparing in the 1990s, when they were being discussed, there was a trend for a lot of large universities and colleges to sell sponsorships to, it's usually Pepsi or Coke. And often part of the deal would be, we're only going to sell your soft drink at our athletic events or on campus or whatever it might be. So this was sort of a hard fought rule that the IRS, stuck to its guns on the regulations. And it's also part of the statute that exclusive provider aspect is going to defeat the ability to benefit from the sponsorship safe harbor.
Yeah, and if you think about it, the idea of agreeing to only purchase products from a particular company, even just thinking about the sort of 2% limit, whatever sponsorship benefit or sponsorship payments might be able to be made, the idea that you will buy products and will only buy products from that company clearly provides a very significant benefit to the sponsor.
Right.
So if we go to the next slide, let's talk about sponsor acknowledgements in the online space. So there are lots of ways and places to acknowledge sponsors online. Common examples are acknowledging sponsors on organization or event websites or in email communications leading up to an event. You can also think about new creative ways to engage digitally, such as through social media engagement. You can think about tweeting at your sponsors or posting an acknowledgement on your organization's Instagram account. So if we go to the next slide, here we have a great example of an association thanking a company for helping them raise $10 million. So we have a big attractive image as the post, and then we have what looks like a meaningful caption. The association acknowledges the length of the partnership, the amount of money raised. They tag the company, which allows the company to easily share and repost the acknowledgement through their own channels. And they used a hashtag and ALs, which makes it easier for the sponsor to engage with the campaign and for users to discover the link between the sponsor and the organization. Importantly, what we don't see here is that there's no encouragement to visit Marshall's website, to go to their stores. There's no special hashtag linking the organization and the company together, but really it's a message focused on the nonprofit campaign and the acknowledgement of support from the sponsor. Now, this is one pretty standard, I'd say typical way that social media acknowledgements can happen and are starting to happen. But there's probably room to get more creative too. So another way you could think about engaging sponsors through social media is with a social media takeover. So this would be where one person or organization posts on someone else's account, usually an account with a bigger or different follower base for some period of time. If you wanted to do this with your sponsor, you'd want to carefully vet how it would work, what messages will be included, who will be running it, but it could be a fun and informative way to both acknowledge and highlight your sponsor's support, while also getting out information about your organization and your issues to a new and broader base of people. So
I would just add quickly, Ryan, that a lot of these developing forms of support that a lot of our public charity clients are using is some form or another of cause-related marketing or benefits through what they call a commercial co-venture, where a portion of each sale of a company's products or services is donated to the charity. And it obviously it's compelling and attractive to want to push people to buy those products and services, even as part of the charity, so you can get more revenue in. But the rules on sponsorship are very clear. To direct, as Ryan pointed out very well on this slide, steer clear of it here. But sometimes it may be attractive to want to direct members of the public to buy a particular product or service to benefit the charity from that commercial co-venture relationship. That would be a substantial return benefit under the sponsorship analysis.
Thanks, George. So if we go to the next slide, so here, as we're thinking about events increasingly existing in the online or hybrid space, there are lots of other ways too that acknowledgement opportunities can be adapted for the virtual world, allowing you to provide benefits to your sponsors online without jeopardizing the safe harbor that we've been talking about. So, for example, at an in-person event where you would likely incorporate sponsors' logos on event signage or in printed programs, in an online or hybrid event, you could think about incorporating them into the background of your virtual platform or the skin of an app that's been designed to support the event. Another common and permitted way to acknowledge sponsors in person is for sponsors to give welcome remarks or have other speaking opportunities at an event, as long as they don't use the time to promote their products. This type of acknowledgement would easily be adapted to a virtual space by allowing a sponsor to speak at the beginning of an event or even during a break in programming, in breakout rooms, or other appropriate times throughout the day. And then finally, at an in-person event, a sponsor could be allowed to distribute samples of their products or branded merchandise related to the event. For an online or hybrid event, we think the same concept could probably be arranged as well. You could think about arranging to have samples of a sponsor's items mailed to event attendees, or invite your sponsors to provide a virtual giveaway, such as a free trial for the sponsor's online services. As with any adaptation of the IRS's outdated rules in this area, it would definitely be important to really think about and craft the giveaway appropriately and carefully, thinking about what's being given away, how it's being distributed, and other relevant factors, depending on the circumstances. But we do think that offering a free sample, such as a 30-day free trial or a coupon to redeem a free item, would likely be less risky than providing coupons or discounts that would require the recipient to make a purchase of the sponsor's goods or services. We think that latter approach would probably be more likely viewed as an encouragement to purchase goods, even though there is this benefit being given to the attendees. So the point here is that there are plenty of ways to be creative and engage sponsors online without resulting in a substantial return benefit. So moving on to the next slide, which we are. So what happens if, despite all these exciting acknowledgement opportunities we've been discussing, you exceed the 2% threshold and provide a substantial return benefit? Honestly, it's okay. If you exceed the 2% threshold, you can evaluate each of the return benefits separately to determine whether they are subject to UBIT and if they may qualify for another exception or modification to reduce UBIT liability. So in a moment, I'm going to walk us through an example, but just as a practice tip first, we recommend drafting your sponsorship agreements with the different benefits being provided, categorized in buckets or categories of benefits, and a fair market value assigned to each. I know we touched on this earlier on in the context of multi-year sponsorship agreements and figuring out how or when the fair market value is calculated, but it's really helpful in this context as well in the event that you are going to exceed the 2% return benefit limit and need to do a UBIT analysis of each benefit separately. So let's move on to our fun example. So here we have a situation where we have a sponsored organization called Drama Llamas Inc. They're a theatrical performance and education group. We have a sponsor, Makeup by Magic, which is a cosmetics company. Makeup by Magic is providing a $10,000 sponsorship payment to Drama Llamas. which sets our 2% threshold at $200. Now, in exchange for the sponsorship payment, Drama Llamas wants to provide the following benefits. So we have the opportunity for Makeup by Magic to distribute their new makeup sampler at Drama Llama's annual Shakespeare in the Parking Lot production. We have a license for Makeup by Magic to use the Drama Llama name in their new makeup color called Drama Llama Dream. We have 3 Instagram posts tagging Makeup by Magic, tagging their account and thanking them for being the official makeup sponsor of the Drama Llamas. We have another opportunity for Makeup by Magic to provide their products, but this time it's for them to provide an online voucher for a free makeup sample. We have 10 free registrations for Drama Llama's improv classes for the sponsor to use as it likes. And then we have an agreement by Drama Llamas to purchase a Makeup by Magic professional kit for each of their principal performers. So a lot of benefits here. So let's think about how we go about analyzing these. So if we go to the next slide, we see that the 3 pink benefits fit under the acknowledgement category. So being able to provide a sample of your product or a voucher for a sample of your product, as we discussed before, should fall under the acknowledgement category and not be considered an advertisement or other substantial return benefit to the sponsor. We also have the 3 Instagram posts, which we talked about before. Having an acknowledgement of your sponsor online and social media is acceptable. It's not added into the 2% calculation. And as we see here, they're called the official makeup sponsor, similar to an exclusive sponsorship. That designation would be fine and totally appropriate in this context and would not impact the valuation of the return benefits. Now, the 3 other benefits that we have aren't acknowledgements, and so we need to think about what the fair market value of each of them is. Here we have $1,000 fair market value for the license, $1,000 fair market value for the improv classes, and $500 for the 5 makeup kits that would be purchased. So in total, that's a $2,500 return benefit, far exceeding the $200 limit that is the 2% threshold. So if we go to the next slide, we see here we've kind of organized them. We have our acknowledgements, we have our return benefits, and we can actually speed right along to the next slide where we think about them in a little more detail. So again, the first 3 acknowledgements are not subject to the 2% calculation. They're not subject to UBIT. They're not considered to have much value to the sponsor from the IRS's perspective. Next, we have the 10 free registrations for the improv classes. And here, the improv classes are part of Drama Llama's educational activities in furtherance of their exempt purposes. So providing a payment for these classes is not unrelated, it's a related payment. And so again, this would not be subject to UBIT. Next, we have the license for the name for the makeup color. And as Judith mentioned earlier, there's a royalty or license exception to UBIT, which this would benefit from. And so we're not going to get into the details of how that works and the nuances, but this benefit or this return benefit would benefit from that exception. And so we now have the license not being subject to UBIT. And then finally, we have this agreement to purchase makeup kits from the sponsor, valued at $500. And this ends up being a taxable benefit. So out of our $10,000 sponsorship, $2,500 in return benefits, what we end up with is a $500 taxable payment and the rest not being subject to UBIT. Now, having gone through this whole exercise, we would really, in your own context with your own facts, we would encourage you, once again, to identify the fair market value of the benefits and put them in the contract to avoid the possibility of these benefits being treated entirely as a substantial return benefit. If you don't identify the buckets of benefits and their values, there's a greater risk that the IRS could determine that more than just the $500 is a taxable payment. So,
And the IRS puts the burden on the taxpayer to show what the fair market value of those benefits are. So to be able to do it at the contract, at the time of contract, as opposed to trying to recreate or figure it out or substantiate it on audit many years later, it's far better position.
right. And so with that, I think we will wrap up the sponsorship discussion, and Judith will take us through a discussion of the qualified trade show exception and how it may apply in the online or hybrid context.
Great. So in some cases, if the qualified sponsorship rules don't really apply, or if you really don't want to do the math that's required under the qualified sponsorship rules, and the activities that you're looking to engage in is in connection with a convention or trade show, there is actually a separate set of rules that you can follow to have the revenue still be exempt from unrelated business income. And so the next slide shows the 3 factors that have to be satisfied. Now, the first factor that I actually look at, although is the second factor, is you first have to be an organization that's exempt under section 501c3, C4, 5, or 6. And the organization has to really regularly host an annual event that qualifies as a qualified convention or trade show. Now, a qualified convention or trade show is, defined as being an event that includes at least as one purpose to educate its members or promote products or services of the industry in general. And so if you satisfy the second and third factors, the first factor sort of generally follows. It's pretty easy to satisfy since it's really defined as pretty much any activity that's carried on at a qualified convention or trade show. So the classic example of what really qualifies under this exception are exhibitors. Now, as Ryan mentioned, encouraging people to purchase goods or services of a company is generally not viewed as advancing a tax-exempt organization's exempt purposes and is generally viewed as advertising. But a tax-exempt organization can have companies come and pay for exhibit space at the organization's annual meeting or other convention, and even allow them to sell their goods and services at those booths to attendees under this exception and still be exempt from UBIT. So as you may be able to tell, the exception is fairly straightforward, especially compared to other exceptions like the one that Ryan just covered, but it becomes a bit more complicated when your event is held online.
I'll take this opportunity now to announce the continuing legal education CLE code is UBIT 2021. That's our CLE code for this presentation if you need it. Back to you, Judith.
Sure. So if you go to the next slide, the reason why this is a little bit more complicated in the online context is that the main guidance that the IRS has given regarding online trade shows is that was issued back in 2004, and the IRS hasn't really done much in this area since then. And the guidance essentially provided 2 examples. One was where an organization was offering a traditional in-person trade show and also offered some content online such as exhibitor information, links to exhibitor websites so that the attendees could essentially purchase the exhibitor's products or services online. This information was made available online, during the trade show dates and a few days before and after the dates. In contrast, the organization in the second example offered the same online content for a limited period of time, but there was no in-person event offered by the second organization in connection with this online content. And so the IRS concluded that the virtual content in the first example qualified under this exception, but the virtual content in the second example did not. And the primary reason that they gave was that the online content did not count as a qualified convention or trade show. And the IRS pretty much said that online content can't be considered a qualified convention trade show because it's not a place where it's not a specific event where people can gather in person at a physical location and interact face to face. And so as you can imagine, the challenge with the IRS guidance is that technology really has advanced significantly since 2004. And so in contrast with 20 years ago, there's really now a range of virtual platforms where people can gather and interact with each other online. And a lot of what could only occur in person back 20 years ago, like networking or educational events, can be done on a virtual platform pretty easily. And so it's also worth noting at this point that the online content that was offered in these 2 examples were pretty static. They were just websites with links to suppliers and vendors. in contrast with the online content that's offered traditionally by organizations nowadays, including offering live events and networking sessions and breakout rooms where exhibitors and attendees and other people can have live conversations.
Right, and this guidance from the IRS, which I've seen IRS do in other situations too, provides just 2 examples and doesn't say which within each of these 2 examples is sort of the deciding factor. What's a more important factor? What are the facts that really cause the IRS to say fits the exception here and not there? But we're left with what we have. So I just note that there are a number of different ways, particularly now, 17 years after this was released, that virtual trade shows can look that are not covered by this guidance.
Yeah, so what does this mean for your meetings moving forward? And the next slide sort of talk about a couple of practical considerations. Now, first, before I go into this, it's actually pretty important to decide if the activities that you're engaging in at your event actually need to qualify for this exception. So if an activity can qualify as being related to your exempt purposes or qualify under the qualified sponsorship exception or another UBIT exception, you don't actually have to worry about the implications of this IRS guidance on whether that activity can qualify under this exception. So, for example, if you're hosting a webinar that educates people on a topic that's core to your mission, you don't have to really think about the implications of this IRS guidance on the taxability of that revenue. But what happens if your event isn't related to your tax and purposes, or it doesn't really qualify for any other exception to UBIT? So for hybrid events, the guidance is more clear, as you can tell from, we can borrow a little bit from the IRS guidance that was issued back in 2004. The online content should ideally be offered during the event dates, but definitely should be cabined within a specific period of time. And you should also include in all of your promotions that the online content is being offered in connection with your in-person trade show or convention. And then last, you should also consider separating out the fees for participating in the online portion of the event in order to minimize the risk that all the revenue that you collect from an organization for both the in-person and the online components will be treated as taxable. Then what happens if you're stuck in the position where your event will be held pretty much 100% online moving forward, and the event doesn't qualify for any other UBIT exception? Well, unfortunately, as George mentioned, we're sort of stuck with this guidance from the IRS. And so there will continue to be a risk that the event with having no in-person component will be viewed as not qualifying for this exception. But we think there are some ways that you can navigate this to try to minimize that risk by trying to make your event be as distinctive as possible from the online content that was provided by the organization in the second example in the IRS guidance. So in addition to limiting the availability of the online event to certain dates, you should also consider ways of, for the participants, for the exhibitors, the event presenters to interact in real time to make it really feel like something that you would do in person as well. So just having breakout rooms for exhibitors that attendees can visit and interact with them and ask questions. You can also have sessions where attendees can have one-on-one conversations with each other to resemble a bit more like networking, and also provide educational content live so as to really maintain the look and feel of an in-person event. And so designing the event to be pretty much as close as possible as what you would offer in person will be helpful, we think, in distinguishing your organization's online event from the second example in the IRS guidance.
I think many software providers that are getting into this game or that have been in this game, for reasons other than the tax reasons, seem to be designing these online events or online aspects of events in just that way. I've certainly participated in a few over this past year plus, where it appears that you're sitting at a table and it appears that there's a podium in front of you, and for the trade show, it appears as though you're walking down an aisle. It sounds a bit form over substance, but that's the key takeaway from that guidance from the IRS. It has to do with the look and feel. It doesn't look like a regular convention and trade show back, pre-internet days. So obviously, to the extent that you're looking at providers of software and other applications to do a hybrid or online aspect of an event, that's something to keep in mind. Is that could very much help with your tax argument. One last point on this that I think will be interesting to see is, this is an area that has not been enforced by the IRS yet at all, really. I mean, we haven't seen any private letter rulings or tech advice, or certainly no further precedential pronouncements on trade shows being conducted virtually. What perhaps, given the proliferation of these types of events this past year, we may see a little bit more by way of understanding of their position. I do know that there have been some groups like within ABA and other groups that with some prominence that have asked the IRS to update this old guidance and bring it back along to current day technology. We've got, I think this is it, right, Judith?
Yeah, so I'm conscious of the fact that we only have a couple of minutes, but we did want to save a little bit of time to sort of answer some of the questions. And so Ryan and George, I know that you've been looking at a couple of the questions while I was presenting, and I wanted to see if you had any that you were wanting to answer.
Yeah, let's go through a couple of them real quick. We've got a little bit of time. There was a question about when we were talking about substantial return benefit, and how would advertising be valued if an organization doesn't normally sell advertising with a stated value or cost. The term or the standard that the IRS applies in the regulations is the fair market value of the benefit. So if you don't have a rate sheet and you're giving ads to somebody, it's going to be difficult to come up with an approximation as to what the real fair market value of that ad is. The one thing I would say is, obviously, don't be too aggressive. Maybe there are some, other organizations or publications out there that you do know the value of those ads. If it's a reasonable position to take, then document it and put it down there. The one point that I want to emphasize here, though, is it's not the cost, right? It's the value. So if the cost of printing an advertisement to the organization, even counting staff time, is X, the value is probably X plus the profit, right? So so the IRS will not look to cost, but rather value. Another question that has come up more in the sponsorship side, I'll sort of turn over to Ryan. I think we have some maybe a math correction to do on one of the slides. Is that correct?
Yes. Don't go to your lawyers for accounting questions. We don't like math. As many of you helpfully pointed out, I think it was slide 17, the 2% calculation was not correctly calculated. The point still stands, though. If you're in a situation where you have a multi-year contract and different sponsorship payments in each year, the return benefit, the substantial return benefit determination can be different in those 2 years. And so really we wanted to highlight the fact that each sponsorship payment and return benefits within the taxable year need to be taken together, even if it's part of the same overall sponsorship.
We'll get the math corrected before we post that on the
Yes.
web. And there was a question that came up with Judith talking about the convention trade show exception. It's a great question. It's would a conference registration count as a related benefit? And that may also apply to the sponsorship discussion as well. And in fact, it applies to both. I've always thought that the qualified convention and trade show exception almost unfairly created an implication or an interpretation that revenue in that bucket otherwise would not be considered as related revenue to a nonprofit C3 or C6 organization. But I think a registration for a conference, even in the absence of being able to qualify for that exception, you can always imagine the circumstances where the IRS might take issue, but the usual conference, educational conference, breakout sessions, even with a trade show aspect to it, those are almost, I won't say almost certainly, but it's hard to imagine a situation where they would not be viewed as related. So if you're counting the value of sponsorship benefits, for instance, and that's a substantial return benefit because it would be viewed as such under the safe harbor rules, you would very likely put that under the related category. Judith, I don't know if you have a different thought on that.
No, I totally agree, George.
And then there are a couple of questions again about what about a demonstration of a product? So you're allowed under the sponsorship rules to display your products, or the sponsor is allowed. You're allowed to let the sponsor display its products at a sponsored activity. what about a demo? And, you know, I think that may be a little closer to, we'd have to analyze what's said and done in that demo. If you're just showing what the product does, it seems unlikely to be in and of itself an inducement to buy. But the context is going to matter a lot there. Ryan, any thoughts on that?
No, I agree. I think that's right. I think it would be context specific. Okay.
It looks like we're actually a couple minutes over now, and I want to be respectful of everyone's time. We did have other questions, obviously, but with our time restrictions, we'll see what we can do to get those answers offline. Thanks everyone for your time. Thanks especially to Judith and Ryan for your great expertise in sharing it here, and look forward to seeing you at our next one. And we are just a preview, talking about hybrid. We are thinking about October, hopefully, to actually have an in-person aspect to these monthly discussions again. So hold that out as an end of year benefit. And I did give the CLE code, so I think we're good on that.
Sorry.
Anyway, thanks everyone, and have a good rest of the day. Thanks again, Judith and Ryan.
Thanks, everyone.